Good morning and good afternoon to people joining from different parts of Africa. Thank you so much for registering and joining the webinar today. Uh, Before we start, I would just like to make a note that we have disabled the chat and audio for all the attendees because we want to have an uninterrupted session of 45 minutes where our panelists, Mr. Satya Vamiredi and Gaurav, who I'm going to introduce shortly, are going to present. And we have kept specifically 15 minutes for our question and answer session on the webinar. But I would recommend and I also urge that you feel free to drop into your question in the Q&A section in the webinar post. So without taking much more time, we are going to start the webinar. So before we start, I wanted to have an introduction of our panelists and also on the topic. So as we all are very aware, we are currently going through one of the biggest black swan event of a lifetime of this generation, which is COVID-19. A lot of travel restrictions, offices were almost shut down, most of the places, but most of the financial institutions have continued to do their best to provide basic essential services when it comes to banking. In fact, in India, we are calling them COVID warriors as well. But undoubtedly, there has been a lot of direct and indirect repercussions of this event that financial institutions have to go through. Most of the central banks and regulatory bodies have also been very closely monitoring all the financial institutions and have also provided a lot of relief measures in form of stimulus packages and relaxed regulation effectively. I was just talking to one of the bankers in Nigeria, which sort of they were telling me that Central Bank of Nigeria has come out with an SME fund to promote SME lending in the country. And there are other packages that have also been announced by other regulatory bodies across Africa. Now, in the current situation where everything is changing and we are also learning new aspects of how to deal with this current situation, it is very important for senior management to be on top of the risk in their portfolios. And that is one of the reasons that when we were planning a webinar session on liquidity, we wanted to bring more sort of information and throw light on the behavioral study that could be adjusted in this current pandemic situation. So in this webinar today, the key areas that we are going to discuss on are embedding liquidity in strategic business planning, understanding balance sheet cash flow behavior, risk factor approach, liquidity stress testing and contingency planning, liquidity optimization and limit setting, liquidity management in current scenario of COVID-19. Before moving forward, I would like to introduce our panelists, Mr. Satya Vamiredi, who's Director Balance Sheet Analytics and Solutions, and joining him would be his colleague, Mr. Gaurav Gupta, who's our Associate Director on Balance Sheet Analytics. Now I'm going to transfer the presentation to Mr. Satya and would request him to take you through the webinar.
Thank you, Pratik. I hope you can hear my voice clearly.
In case there's any issue, please do raise a hand and we'll respond. Currently, their voice is muted, so they will not be able to speak.
Yeah, so you can hear my voice clearly, right?
Yes.
Okay, thank you. Yeah, so I mean, let's briefly start with the fundamentals before going into how this current scenario, the COVID-19, has impacted banks in terms of their liquidity positions, and what actions banks need to take across various aspects of risk management, starting from the governance frameworks, the risk measurement and monitoring frameworks, stress testing, behavioral modeling, and actively preparing action plans to respond to a scenario like this, and how all these processes tie up into the overall liquidity management function of a bank. Starting from the most fundamental understanding of liquidity, it's essentially the ability of a bank to fund growth in its assets and also meet all its obligations. They may be deposit runoffs or redemptions or just customers withdrawing on their accounts, so on and so forth, as they come due without incurring unacceptable losses. So unacceptable losses typically would mean that they don't have to replace those deposits running off with high cost deposits, or having to sell off certain liquid assets at deeper haircuts than normal. So a bank which can effectively manage its day-to-day operations in terms of raising funds and meeting its obligations will be doing good in terms of the liquidity risk profile. So primarily, we can classify liquidity risk into two aspects. Primarily the major portion of the risk, which is you typically call liquidity, is the short-term liquidity risk. Short-term liquidity is the most critical element of managing a bank. Despite credit risk being a significant portion of the risk profile of any bank, but liquidity risk is event-driven risk. It is typically very short-term in nature, and thereby it is very essential for the banks to be able to uh, uh, monitor and take very quick actions to restore any runoffs or any declines in their liquidity positions. And as we have seen in the previous crisis, which is the global financial crisis of 2008, and even now under COVID-19, the first repercussions of any such crisis, even other crises that happened in between, like the oil price crash that happened in 2016, 2017. The first repercussions that you see are a sharp decline in the levels of liquidity within a market. And this makes it very difficult for banks to roll over their deposit positions and borrow further in the market from other financial institutions or even corporates. So the ability to meet immediate requirements, necessarily means that banks have robust access to liquid markets and have internal sources of liquidity which they can use in terms of in times of need. So short-term liquidity liquidity risk can be mitigated by holding sufficient levels of cash, unencumbered liquid assets, which also called HQLA as per the Basel III regulations. And the second aspect of liquidity risk is the structural liquidity risk. And structural liquidity risk deals with the long-term composition of the balance sheet. What it means is it will ensure that the bank is able to survive over the long term. As it is important to manage the short-term liquidity, it is also important to ensure that in the long term, the assets which are lent for long term are supported sufficiently by long-term funding. Long-term funding could be capital, the core portion of your current and savings accounts, and term deposits, which usually have tenors anywhere between 6 to 2 years. So a right proportion of these funding tenor compositions will ensure that as banks go through a situation, there is sufficient level of long-term stable funding for the bank to fall back on, and they don't have to worry that this stable funding will run off during stress. So, and these two aspects are primarily what has driven the Basel committee to define the liquidity coverage ratio to manage the short-term liquidity risk, and the net stable funding ratio to manage the structural liquidity risk. So given the base, the understanding that we have just tried to develop on what is liquidity. Now we'll look at how liquidity can be embedded within the overall daily management of the bank, as well as the long-term strategic planning. uh, you know Banks usually, at the board level and at the senior management level, there is always a vision in terms of the direction that the bank needs to take, in terms of the medium tenor, which could be 1 to 3 years, or the long term strategy, 3 to 5 years, or even 10 years horizon. And those kind of strategic plans involve the final in terms of the target balance sheet size, in terms of the profitability, in terms of the credit profile of the bank, in terms of how the bank wants to position itself in the market. So such strategic planning decisions would need to take into account liquidity as a fundamental aspect. That is simply because if the level of growth projected on the asset side cannot meet the level of projections or the stability of the funding in the projections, then bank eventually will run into trouble in managing the liquidity aspects. So it is very essential to understand not just the current level of liquidity within the bank, but also embed liquidity in all future decision making. And so at a high level, it is difficult to quantify how this can be done. So in order to do that, board and senior management then drive down the actions, or assign the actions, specific actions through the risk management framework. So it is essential that boards see through that banks have a robust risk management framework, which has clear roles and responsibilities in terms of the management of liquidity and liquidity risk within the bank. So starting from who will be responsible for setting up the policies, or who will be responsible for measuring the risk, who will be responsible for monitoring the risks on a regular basis, and who will be responsible for ensuring that the process setup have been followed consistently. And finally, who is responsible to ensure that the policies and the frameworks are reviewed on a regular basis and are in line with the complexity of the bank and the scenario prevalent in the market. So usually, this comes with a first line of defense, second line of defense, third line of defense framework, where the first line is usually the business themselves, who should ensure that when they take on liquidity risks, they clearly understand the nature of the products that they are dealing with. And we'll see what it means to understand the liquidity of a product in subsequent slides. And then the second line of defense, who are the control functions of the bank, which could be finance or risk, who are responsible for the policies and measurement and monitoring of the risk on a regular basis. We'll also see how these frameworks can be enabled. And then the third line of defense, which could be your internal audit function, which ensures that the the front line and the control functions are following the risk management objectives and policy setup. And so that then takes us to the liquidity assessment aspect. The liquidity assessment is simply taking into consideration the current position of the balance sheet of the bank, and be able to say whether the bank is able to meet its obligations and growth requirements effectively. So liquidity assessment not only takes into account the current position, but it also needs to take into account the immediate future plans. So based on which the assessment of the level of liquidity can be made. So this can take into account various liquidity metrics like your LCR, NSFR, which give banks an indication and be able to benchmark themselves with the peers in the market as to the level of liquidity that they are holding. And behavioral modeling is also an important aspect of liquidity assessment, because ultimately the cash flows which the banks monitor on a regular basis, what's the outflows and what the inflows, more or in most of the cases these are not as per any defined contractual maturity. And even if there are contractual maturities, there are always options given to the customers to adjust these cash flows in terms of prepayments on loans and early redemptions and runoffs on withdrawals on current and savings accounts. So it is very essential to understand this behavior and what factors how the current economic scenario is in terms of the GDP growth, the interest rate levels, other important commodity prices like oil prices for certain economies, and how the stock markets themselves are doing. So these kind of aspects become very important in assessing behavioral behavior of customers. So we'll also look at these aspects. And the other important aspect is stress testing. So banks need to be able to understand that under normal circumstances, you expect to grow at a certain rate, and you expect that most of your deposits will be rolled over and renegotiated at a certain price prevailing at that point in time. But stress testing, is very important in understanding what if those kind of assumptions break? What if you are not able to roll over a number of deposits? What would happen if there is a severe drawdown on your current and savings accounts, which could be much sharper than your BAU runoffs? What would happen suddenly if you lose access to funding markets? What would happen if oil price sharply drops today, from the level it is to something like $30 or $20 a barrel? So these kind of plausible scenarios need to be constructed, and banks need to understand how these scenarios in turn drive the balance sheet and the cash flows to be able to understand how the stress will impact your liquidity positions. And deriving from these liquidity assessments and stress testing is the appetite and limit setting activity. So once the bank clearly understands what is my current liquidity position, what are my immediate future requirements, and what would happen if there is a kind of stress which can originate in the market today, how would that impact my liquidity positions? So taking all these factors into account, banks need to establish certain limits in terms of liquid asset holdings, in terms of stable funding holdings, in terms of the level of ratios like loans to deposits ratio, current assets ratio, long-term assets to short-term liabilities. So there are a number of metrics which banks can use, other aspects like funding concentration, tenor concentration, for example. So there are a number of metrics which can help banks monitor their liquidity profile as well as funding profile, which needs certain metrics, which needs certain limits defined, and these limits need to be defined independently for business as usual as well as stress testing. So it is also important to understand that what is the minimum level that I want to go in BAU, and what is the minimum level I can go under stress testing. So once the bank has a level of understanding in terms of what will happen during stress testing, then when stress actually occurs, there will be less panic and confusion as to what is the level of liquidity that you need to maintain. And that leads to the contingency plan, which is nothing but a detailed response to each type of stress scenario, plausible stress scenario that has been modeled as part of your stress testing exercise. So contingency funding plan could be in the form of immediate actions to meet the obligations, like taking raising additional funding through repo of your liquid securities or liquidation of your liquid securities, or accessing the central bank funding windows, or trying to raise additional deposits from strategic depositors, um, or going to market over a period of time to improve the position, liquidity position, and structural funding position. And then there could be medium to long term actions, like issuing long term debt instruments to reset the funding profile of the bank. So, and that then takes to the liquidity optimization. So while contingency plan looks at immediate response to stress, liquidity optimization looks at the long-term optimization of the balance sheet, which ensures that the profitability is optimized. At the same time, the bank is able to comfortably tide out stress scenarios. And these elements then tie into the strategic planning. So once the bank and their management clearly understands what are the current level of liquidity, what are the weaknesses, what are the level of appetite and limits that I need to set for myself, so that I'm comfortable while ensuring that I have optimized it for the maximum profitability. So this can drive into this strategic planning which we started with. So so this gives overall understanding in terms of all the key aspects that management needs to look at when managing liquidity risk. So from there we can go into each aspect that we have touched in the earlier slide, and understand in a bit more detailed way how though each of those aspects can be operationalized. Starting with assessing the liquidity requirements. The most fundamental tool that most banks use today to monitor and measure their liquidity and liquidity risk is the structural mismatch reports. Structural mismatches give a good understanding of what are the cash inflows and cash outflows in various periods of time into the future. So in terms of the next 1 week, what are the cash flows that the bank is expecting to come in, and what are the cash flows that are expected to go out, and 1 week to 15 days to 1 month, 1 to 2 months. So the more granular the short-term buckets are, overnight and daily frequency until the first week, weekly frequency until the first month, and monthly frequency out until 6 months. The breakup of periods into these liquidity buckets will give a very good understanding in terms of how banks need to plan out the next actions in terms of managing the liquidity. So the structural mismatch report tells the bank what is the shortfall in funding over the next 1 day, next 1 week, so that banks can actively plan to raise funds and also manage their disbursements over the period of time. And in terms of optimizing structural mismatches, certain strategies like staggering the deposit originations and maintaining a healthy distribution in terms of the tenors which are raised will help stabilize the mismatches. So this is where you can take into account at what periods of time the deposits are raised and what tenors those are raised, to ensure that in any of the buckets you have only the size of deposits which mature should be always less than the deposit origination capacity of the bank. So it is so in this context, it is very important for banks to understand a concept called maximum origination capacity. So this will need banks to look at all their existing relationships, and explore new relationships in the market, and understand what is the propensity of these customers to provide funding to the bank, and also what is the size of funding that you can expect to extract from these customers. So this metric, not only you need to look not only for a BAU perspective, but also stress perspective. So, I mean, a clear example will be under stress, you cannot expect any financial institutions or banks to give you funding. So, so you would only look at, a subset of those customers to be able to raise funding. And then we move on to the behavioral analysis. And behavioral analysis gives the true behavior of cash flows. So structural mismatches often are largely contractual in, prepared in a contractual fashion. So what it means is the buckets are, slotted in such a way that the cash flows that are coming in sit as per their contractual, repayment profile or maturity profile. But this does not do justice to the real world, where the cash flows the inflows may get delayed. There could be prepayments, or there could be additional unexpected runoffs. So it is very important to understand this behavior, and that we will see in a bit more detail in subsequent slides. And an important aspect of managing liquidity is to ensure that the liquidity position meets the regulatory requirements. Of course, that is indispensable part of being in the banking business, is to meet the regulatory requirements. So various ratios like LCR, NSFR, loans to deposits ratio are usually prescribed by various regulators, and there could be some additional stock ratios or dynamic ratios which certain regulators may prescribe. And it is very essential that the regulatory ratios are also part of the BAU and the stress assessment of banks. And in terms of the regulatory ratios, it is very important for banks to understand the sensitivity of these ratios to various important funding positions of the bank. How does a 10% change in the funding level from FIs change a particular regulatory ratio? How does a drop in your retail segment impact these ratios? So once you have the top sources of funding which are driving the sensitivity of these ratios, it will help banks to stabilize the regulatory ratios over the over a course of period. So one of the key issues which most banks deal with is the volatility in these ratios. LCR is notoriously volatile in most banks. I mean, we typically or regularly see a lot of banks, in Africa and the Middle East, and even, I mean, it's a issue globally, because LCR is a very sensitive ratio, because you're only looking at the next 1 month period, inflows and outflows. So that makes the ratio quite volatile. And understanding the sensitivity of various funding sources and actively managing those funding sources will ensure a reduction in volatility. And rating agencies, regulatory bodies do look at daily, computations of these metrics, and individual components are also actively tracked. And based on this, the liquidity profiling is done. So it is very important for the sensitivity analysis and subsequent active management. And the last aspect of assessing liquidity involves bringing into the analysis the short to medium term, business plans, where, for example, you could look at your budgeting exercise, which is typically done over a 12-month horizon. Bring in the impact of the growth, restate your gap statements, structural mismatches, behavioral gap statements, and LCR, NSFR, and other regulatory ratios uh, for all the projected 12 months, and taking into account how various portfolios are growing. And this gives a clear understanding of whether there is any shortfall or any weakness in the business plan. The and unfortunately, a lot of banks lack the ability to do dynamic planning because it involves complex Excel models to forecast cash flow statements. Because what instead most banks do is assume certain percentage runoff factors and quickly recompute the ratios and gaps using stock balance sheet approach. So what most banks do is they just look at the total balances after the end of first budget month, and use those gross balances to assume certain percentages of runoffs and recompute ratios like LCR. What this kind of approach ignores or fails to highlight is the maturity pattern inherent in various fundings and asset positions. Uh, it could be that there is tenor concentration in your funding profile. That means within the next week you see a big lumpy deposit portion maturing. If you assume a constant percentage of runoff across the 12 months, it may so happen that after 3 months, there is around 20% of your funding profile worth of deposits maturing during 1 month, which may not come out in the analysis if you use a static approach. So it's very important for banks to restate their cash flow mismatch position, not just make assumptions in terms of their runoffs, to actually understand the weaknesses and lumpy deposit profiles, and then based on that take active decisions in terms of filling those weaknesses. So following from there, we look at a bit more into certain approaches of behavioral modeling. When a few portfolios that banks usually look from a behavioral modeling perspective are your non-maturing deposits. So non-maturing deposits typically forms anywhere between 20 to 50% of the funding composition of customer deposits, and in certain jurisdictions that is even higher. 60 to 70% of deposits are non-maturing nature. So when you have non-maturing deposits which can be withdrawn at any time, it is not only important to understand what portion of deposits would run off tomorrow, but also important to understand what is the actual stability profile of your entire portfolio. As in, what portion of your deposit you can expect to stay with the bank until 1 year, what portion you can expect to stay above 2 years, and what portion you can expect to stay above 5 years. Basel references core deposits in its liquidity regulations, and one of the criteria of being able to classify a deposit as stable is that the deposit balances stay with the bank consistently for a long period of time, even during stress periods. So a 1 year horizon is a critical differentiator that Basel adopts in terms of distinguishing between stable and non-stable sorts of funding. But from a behavioral modeling perspective, you would look at something like 4 to 5 years of tenor to actually understand the stability of the deposits. So here we'll discuss a high-level approach of how banks can not only understand what is the immediate runoff observed in their portfolios, but also how to actually understand the long-term stability profile of their deposits. So certain approaches like computing, standard deviation in daily balance levels, or looking at the minimum balance, with the bank over the last 1 year, 2 years, or observing changes at a gross level on a daily basis. So these kind of approaches used by the banks have very minimal realistic applications. That is simply because just looking at the volatility of the balances, daily balances, does not actually tell anything about what will actually happen tomorrow. So for that, to understand that, banks need to look at sufficient historical data at the level of granularity, which will give them an informed view of what level of uh, stability is existing within the portfolio. Uh, so this starts with, first of all, identifying what are the major cohorts in the data. So what I mean is, cohorts are a way to classify your accounts, which are expected to behave similarly under different business or market scenarios. So these are what Basel calls homogeneous portfolios. Homogeneous portfolios comprise of customers who are expected to behave, similarly under similar uh, uh, market or business environment. So they could be, differentiated using a host of parameters. We'll quickly look at those parameters. Starting with, what is the nature of the product on offer? Is it a savings account? Is it a current account? Is it a call account? So each product has a different objective, or it fulfills a certain use case for the customer, and this derives different behavior. The size of the accounts, whether it is size of the accounts, is a very important aspect that a number of regulators define to be able to differentiate between stable and non-stable funding, especially given a large number of small ticket accounts are expected to be much more stabler given their diversification, rather than big ticket, small customer base accounts. And then you look at the rate that is paid on the deposits. So rate is one of the key lever that banks can use to ensure that they retain a sufficient level of funding. So the differential between what the bank is paying to the customers compared to what the peers or the market average is, and trying to understand how that differential impacts the runoffs over a period of time, also gives an understanding of whether how interest-bearing accounts will behave differently from non-interest-bearing accounts. And the transactional or operational classification, which has been provided by LCR, where you understand whether a account is being actively used for salary transfer, regular operational uses like bill payments, point of sale transactions, and if the account has been with the bank for at least 1 year. So these kinds of classifications, and if there are regular transactions being made using this account, over the last 1 year on a monthly basis. So these kind of attributes define whether an account is transactional or not as per the LCR classification. And similarly, on the corporate side, you look at what are the various facilities that are being used by the customer or deposit account holder, whether he is utilizing escrow facilities offered by the bank, payroll facilities offered by the bank, or any other cash management facilities offered by the bank. So the more facilities used by the bank, by the customer on a particular account, the more stable or operational that account is expected to be. And of course, and then we look at currency, local currency versus foreign currency distinction clearly differentiates the behavior. A number of times foreign currency deposits are expected to be more volatile than local currency deposits, given that local currency deposits are derived from the actual savings of the local population, whereas foreign currency accounts are usually held for specific transactional purposes. Nationality, residence, again, the length of relationship with the bank, the internal customer segmentation. So banks may use certain demographic information, the salary level, the type of job, the net worth of the individuals to classify them as mass or high net worth individual or privileged banking. So these customer segmentations have some logic, and they can actually distinguish between the behavior of the customers. And of course, the line of business, whether these products are offered by your retail, your high net or wealth banking or corporate, also play a key role in how these accounts differ. So the first aspect is to identify all such important differentiators and classify and group the accounts into separate cohorts based on these combinations. And then what needs to be done is a single factor analysis, which will tell how each of these attributes that we just discussed impact the historical runoffs. So here, it is important to identify exactly what is it that you're trying to behavioralize. So for example, for prepayment of loans, it is obvious that the factor that we are trying to model is the prepayment rate. That is, during a certain period, what are the contractual payments and what is the excess repayments expected and as per the behavioral observation over the contractually receivable payments. Similarly, when you look at deposit redemptions, again, it is very clear, or again, within a given period, if these are the outstanding deposits, what portion of those outstanding deposits which don't mature today will actually be redeemed today. And when you come to non-maturing deposits, that aspect is the runoff observed in the accounts. So the runoff is not a daily movement in balances. In fact, the runoff should be looked at from a qualitative sense, in that for example, a metric like average balance will give you a clear indication. So if a particular customer uses the account for salary transfer, you would know that on an average, if he has residual savings after his expenses, on a monthly basis, the average balance in the account will gradually go up. On the other hand, if you see that in one particular month he has made a large purchase, you will see that the average balance suddenly drops. So this kind of average view or a mid-month view rather than a daily view will give a better picture of the long-term stability of the balances within an account. So it is important to track this average balances across these data cohorts over sufficient history, which is anywhere between 5 to 10 years of history, to understand how this runoff actually materializes. And once the single factor analysis is done, which will, tell you which are the important factors and which are not. Then you can form the homogeneous portfolios, like, for example, retail mass customers, local currency. This is a homogeneous portfolio. Corporate banking, current account, of this particular currency. This is a homogeneous portfolio, because you have seen that these portfolios have behaved differently historically under various business environments prevailing over the last 5 to 10 years. And then once you establish a baseline historical profile, you then try to project that into the future by doing certain multi-factor regression analysis. For example, that how the GDP growth has been doing the last 5 years, how the interest rates have been during the last 5 years. So regression analysis can tell us whether the runoffs that you have observed historically have anything to do with any of these factors. And a multi-factor regression analysis will help you understand the underlying relations between how the balances evolved and how it can be used to project these kind of behaviors into the future. And I mean, these are a few examples of the products that we just described: non-maturing deposit runoffs, retail loan prepayments, term deposit redemptions, and revolving facilities and undrawn commitments, how these facilities draw down. So a similar approach can be used and should be incorporated to better understand the profile of these. So the next important aspect of liquidity management is stress testing. And most regulators, from PRA to most Middle Eastern regulators to a certain select few African regulators, have started asking banks for internal liquidity adequacy assessment. And ILAP, one of the core components of ILAP is the stress testing. And the ILAP regulation, in no uncertain terms, asks bank to perform a risk factor based approach to understand the weaknesses inherent in their liquidity profiles. So what exactly is a risk factor, and specifically in this case the liquidity risk factor? At the end of the day, ALM desks or funding centers manage liquidity by looking at what is the net cash outflow or the funding shortfall expected in the next 1 week or next 1 day, so on and so forth. But what are the factors that drive this funding shortfall? So it is simply what factors impact the inflows and what factors impact the outflows. So in terms of inflows on the asset side, most of the inflows for a bank come from loan repayments. So what could impact these loan repayments? Delinquency and default risks carry a big weight in terms of modeling the inflows. The second, on the liability side, on your non-maturing deposits, what is the level of runoffs? Will the runoff be higher than expected, lower than expected? Off balance sheet risk, these are commitments or facilities to extend letters of credits and letters of guarantees where there could be drawdowns or devolvements which are contingent upon certain events occurring. Deposit pricing, the level of pricing which is currently prevalent in the bank, in the market, and if banks don't actively meet the pricing requirements, there is always a risk that customers may withdraw in higher numbers than expected and may not wish to roll over with the bank. Market volatility, in terms of FX risk, and also the valuation of the liquid portfolio. So these factors also impact whether the bank will be able to quickly liquidate or convert their liquid holdings into cash to meet the obligations. Funding liquidity risk is whether the bank will be able to access funding markets. Would funding markets be still alive if there is a severe stress in the markets? For example, when oil price crashed to around below $30 sometime in 2016, uh, there was a sudden freeze in most funding markets, in interbank funding markets, and for other financial institutions which rely on banks, or which rely on institutional investors, which rely on mutual funds to place liquidity with them. So most of these, wholesale markets have dried, dried very quickly, once the shock of the scenario set in. So access to funding markets, or whether the funding markets are operational, is a very important factor that drives liquidity risk. And customer concentration, whether there are any large customers who may withdraw today. A runoff of multiple number of smaller customers may not impact the bank, but runoff of just the large two customers can cripple the bank in terms of liquidity. So it is very important to model these factors. And other factors like tenor concentration, whether the deposits are adequately distributed across tenors, transferability risk, whether the liquidity which is held, is it held in a jurisdiction which can quickly transfer it to the place where it is needed, or overall at a group level, the bank may be well above the 100% LCR threshold. But when you actually look at its subsidiaries and holding positions, certain subsidiaries may be very high on liquidity, but they may not be able to transfer their liquidity to other regions which require liquidity during times of crisis. So legal hurdles and repatriation restrictions need to be looked at to understand these factors. And the last one, the market access risk. So this is the situation where the funding markets are active, but the bank, for various reasons, is unable to access the markets. It could be technological disruptions. It could be because of credit downgrades. It could be because of a reputational risk event. For whatever reason, these kind of uh, uh, when such scenarios materialize, banks may fail to be able to access the markets. So these factors in turn can be, quantified by looking at various historical information with respect to, various other macro market factors. For example, you can look at historically how the deposits have rolled over, or historically what has been the delinquency rate observed in your portfolios. Historically, what is the level of haircuts applicable on certain investment books, which could be reported in the market, and how those historical trends track with respect to various macro and market indicators and interest rates. So building this understanding is very critical to be able to model how the balance sheet will react if interest rates suddenly, they are, in most jurisdictions, interest rates are going very low and near zero. Even dollar has gone below 50 bips across the longer tenors. So in such scenarios, how does that impact your current account portfolio, which does not pay any interest? Or how does it impact your term deposit portfolios, which pays interest? So these kind of relationships needs to be built. And then using these relationships, you need to be able to project or restate your gap statements into the future. And when modeling a liquidity event, unlike credit risk, which is expected to be modeled over a horizon of 1 year, liquidity risk is an event-driven risk. That means a shock occurs and the market readjusts to the shock. It is not a gradual deterioration. Gradual deterioration can be managed fairly easily. But liquidity risk is notorious in the sense that it is a very sharp and immediate reaction to a event that occurred in the market, like crash in oil price, or the COVID-19 situation, when suddenly a lot of economies started in locking down their economies. So it is essential to understand the impact within the first week of a high severity liquidity stress, uh, a medium severity 1 month subsequent period, and a lower severity 3-month horizon. And this is the typical recommendation by most regulators. And especially in COVID-19 scenario, uh, given that banks have already witnessed severe disruptions in liquidity during the global financial crisis, regulators have been very active. Uh, One aspect that helped during COVID-19 was banks are now much well holding much better levels of liquidity buffers compared to when they were during 2008 financial crisis. So that really helped banks. So that is why, even though a number of wholesale markets dried up pretty quickly, there were no news of anywhere that banks are facing difficulties in rolling over their deposits or managing their outflows. That is simply because banks have been mandated to hold a minimum level of liquidity by regulators in terms of LCR and NSFR. But still, we haven't seen the end of this situation, and it is very important to closely monitor and adjust the behavioral assumptions to accurately measure the severity of the scenario. So these are a few illustrations of how a modeled stress can impact various ratio projections, and how what actions that banks can take to recover the ratios back to the BAU levels. And when performing the risk analysis, it is important to understand what are external factors or systemic factors, and what are internal factors or idiosyncratic factors. Idiosyncratic factors could be your own exposure to concentration from few sources of funding, or your reliance on few jurisdictions which raise most of your funding, or uh, any other off balance sheet commitments which the bank may have, or various step in risks, what is defined as per BCBS, uh, where the bank has to bail out certain entities where it has no contractual obligations but to maintain reputation. And other systemic drivers like pricing of deposits, delinquency levels in portfolios, runoffs observed across the markets, so on and so forth. And I mean, to prepare well or identify or preempt liquidity stress, banks need to build a robust early warning framework, which includes monitoring both external environment and internal bank specific indicators. These could be both qualitative and quantitative. So qualitative could be just general news or expectation of certain events in the market, or news of certain attacks or natural calamities that occur anywhere in the vicinity of the operations of the bank. Other internal indicators could be sentiment analysis of the bank in the market, in social media, a negative credit outlook given by various rating agencies, or certain breakdown in relationships with counterparties, or decline in credit lines. And quantitative indicators, could be any of the market factors, oil prices, stock market indices, credit spreads, pricing spreads, which are external. And internal could be your own deposit profile, concentration, delinquencies, so on and so forth, which we have discussed. And we have also touched briefly on contingency funding plan, which could be mobilizing immediate funding to meet the outflows. and then in medium term to restore the ratios to BAU, and then in the long term to optimize the liquidity profile of the bank. So these could be, tapping interbank markets, undertaking repo transactions, accessing central bank funding windows to immediately tide over the stress, and in the long term or in the medium term, pay higher rates to borrow from various funding sources or strategic depositors, and in the to optimize the balance in terms of restructuring the funding profile by issuing long-term notes and right shares, for example. So a few pointers from Gaurav in terms of the specific aspects of managing liquidity during pandemic. So Gaurav, if you want to quickly cover these.
Yes, yes. Thanks, Satya. So the first thing which I want to highlight is that the banks need to focus to continue their franchisee viability, because the last thing which the banks or the government want to make the economy come to a standstill position. So the primary focus in this COVID-19 situation, which in fact the government is also promoting by providing various set of incentives to the banks, by providing incentives to the SME sector, which Satya highlighted earlier, that they have to maintain this franchisee viability, to maintain the customer or the flow of the liquidity to where it is needed. Another thing which banks need to do is the recalibration of their existing stress testing scenario if they already have, because this COVID-19 situation is something which, or this is the first time this situation is happening, or this is something which is a black swan event. We have to recalibrate the stress testing scenario in assuming that what else can go wrong, this type of thing. Another aspect which is to have an increased HQLA buffer. Here, banks need to distinguish between the actual cash or the securities which have the ability to generate cash. Generally, banks prefer to have securities which can generate cash, but in such type of scenarios, we will prefer to have cash, because the ability of a security to generate cash can deteriorate very easily, because it can depend upon the valuation, it can depend upon the interest rate, which are anyways very dynamic. Next thing is the apart from that foreign exchange, due to this volatility in the market, the foreign exchange remittances, in for which let's say few countries are very much dependent upon the foreign exchange inflows. So they have to take caution that they have to reduce their reliance on these foreign exchange remittances. Another aspect is the IRBB management. If possible, in this current scenarios, the banks needs to reduce their IRBB, the interest rate risk in their banking book as much as possible. So the only option is to reduce the fixed rate loan commitments and to move most of the loan commitments to floating rate in nature, or at least do a mesh maturity funding type of thing. Not to forget about mentioning the increased frequency of ALCO meetings. So if we are all tracking all these things which Satya has highlighted, but the ALCO is not made aware of these things, ALCO is not made aware of the happening in the market, so all these things will not materialize into action. So increased frequency of ALCO meetings, and the reporting is reporting to senior management as well as the reporting to their regulators, because a clear communication with the regulator is very much needed, so that if required, the regulator can help the financial institutions in a timely way. And to summarize it all, the ability to perform integrated data analytics, because nowadays we cannot treat the liquidity risk or the credit risk or the interest rate risk in a silo approach. We have to perform an integrated analysis on the overall balance sheet, again, which boils down to having the more frequent and the dynamic cash flow forecasting, which takes into account the way the market are behaving right now. Everything is so dynamic that we cannot assume that the cash flows which we have projected last month are still valid. So this type of thing means I frequently forecasting your cash flow, taking a stock of the what the actual situation is, more interaction with the business people who have the actual feel of the business, who have the actual feel of the customer, what they are thinking right now. So this is the gist which we are suggesting for the our customers, for the banks, they can follow in this liquidity management during this pandemic. Yes, and more
Uh,
information is available on our blog also. So now I
Thank you
am
so thank you so much, Gaurav. Now we'll put it on for a few questions. Though we have crossed the line, so we'll take two questions right now, and then post that. What we will do is we will share the webinar link with all the registrants, so that you can also go through this presentation again. Thank you. Satya, there are two questions. If you can maybe share some light quickly on them.
Yeah, I'm looking at a few questions. So one question we are seeing is if we will share this presentation. So Pratik, you can take a call on that.
Yeah.
Um, uh, I mean, we'll definitely share certain content. And in terms of testing CFP, so most regulators are asking that CFP should not just be on paper, and it should actually be actionable immediately in times of stress. So certain things that banks can do to ensure that the CFP is regularly tested and actionable. There are two aspects to it. One is the operationalizing the CFP, which is also called the dry testing of CFP, where you ensure that all the elements required to action or operationalize the CFP are in place. So for example, is the bank regularly generating liquidity reports to monitor whether the current level of liquidity is adequate or not? The various sources of funding, the contact information of your key funding sources, contact information of your regulators, certain early warning indicators which predict whether there is going to be stress in the market or not. The list of key personnel within the bank who comprise the contingency team, which is expected to take over during times of stress. Are the personnel available at all times, or at least their backups are available at all times or not? So these dry aspects or the operational aspects can be tested on a regular basis by where ALCO or risk management department can be given a mandate to say that today on a random basis define that today is the start of a stress period, and then the actions prescribed in CFP, where you convene a contingency team and where you look at your current profile, your immediate requirements, and your ability to contact all your funding providers, ability to quickly prepare a response to the media, ability to for the CEO or the immediate person to address the central bank and all stakeholders is in place, and all the chain of command that is required to implement the actions, such as increase in deposit pricing or mandate to go after additional source of funding, those can be operationalized very quickly. So that kind of dry testing can be done where the availability information, the availability of personnel can be tested on a random basis. And the wet testing part, or the actual actions that the bank can take in terms of the readiness of the bank to take actions, where whether the bank is able to access central bank funding window, has it tried to do it before in the recent past, the ability to of the bank to repo its liquid portfolios with either the central bank or any other counterparties, has it recently done it? The ability of the bank to raise or contact institutional investors or other hard deposit sources to raise immediate funds. So such operational capability needs to also be tested on a frequent basis. While dry testing or verification of information and personnel can be done on a more frequent basis, the aspects related to operational readiness can be assessed every on a quarterly basis or a semi-annual basis, whichever is comfortable to the bank and the regulator. And another question is, throw light on different scenarios which the bank can consider in liquidity stress testing scenarios. So there are two views, while defining stress testing, scenarios. The most important view is how the regulators look at stress testing. Regulators usually define liquidity stress testing as a response to a short-term event, typically of a 3-month tenor, where banks need to look at systemic drivers as well as idiosyncratic drivers, and also combined drivers to assess impact on the liquidity position of the bank. So how do you define what are internal idiosyncratic drivers and systemic drivers that we have seen? So this is essentially a regulatory model or a risk factor driven model. Another way is a scenario analysis, which is oil price crash, a significant reputational event, limiting the bank to access funding markets, or a credit downgrade, which can restrict the funding sources available to the bank, or some technology disruption, which may lead to inability of the bank to use its branches to raise funds. So these are internal or idiosyncratic scenarios. While for example, oil price crash and economic downturn, these could be, or a scenario like global financial crisis, where there is a when one of the large banks in the market folds up, or a large international bank folds up, or there is a sudden freeze in wholesale funding markets. So a number of such individual scenarios can also be assessed, because these are primarily event driven, and a combination of those factors can also be looked at. So those are the questions which I've seen in the chat, and there are a few. Yeah, I think and that's what we have seen.
Yeah, okay. So I think with this, we will wrap up our webinar. Thank you so much, Satya and Gaurav, for enlightening us with liquidity management during these times. And thank you everyone, all the attendees for joining us today. And we will also be hosting various other topics on risk and enterprise risk management over the period in next few months. And we would request if you could join with us. Thank you so much.
Yeah, thanks for joining, everyone. Thank you.
Thank you.